South Korea weighs scrapping planned 22% crypto tax. South Korea is reportedly considering scrapping the 22% capital gains tax on cryptocurrency profits that has hovered over the country's retail market for 5 years, according to a report shared by Watcher Guru on May 22nd. The tax was scheduled to apply to annual crypto gains above 2.5 million won, roughly 1,800, and had already been delayed multiple times under pressure from the country's large retail trader base. If lawmakers follow through, South Korea would join a small group of major Asian jurisdictions where crypto profits go untaxed at the personal level. That would be a notable reversal for a market where the tax was first written into law in 2020 and has been a political flashpoint through 3 election cycles. A tax that was always on the runway, never on the books. The 22% rate combines a 20% income tax with a 2% local surcharge, and it was originally meant to apply from January 2022. Successive administrations delayed implementation, first to 2025, then to 2027, citing concerns that the tax framework was too aggressive relative to how stocks were treated and that exchanges were not ready to issue tax documents at scale. Retail traders, who at peak account for a significant share of global spot volume in pairs like XRP and Bitcoin, lobbied hard against the rule. Politicians in both major parties have used a softer line on crypto taxation as a way to court younger voters, who are heavily represented in the country's roughly 6 million active crypto investors. Inside the 2.5 million won threshold. The threshold of 2.5 million won is low enough that it would have caught most active retail traders rather than only large positions. Gains above that level would have been taxed at 22% with no preferential long-term holding rate. Stock investors in South Korea, by comparison, face a separate gains tax regime that has historically been lighter for small account holders, a contrast that the crypto community used to argue the rule was punitive. Abolishing the planned tax would not change the treatment of crypto businesses, which are still subject to corporate tax, value-added tax on services, and one stablecoin disclosure requirements introduced in late 2025. The change being discussed, as reported, focuses on individual investor capital gains rather than the broader regulatory perimeter. Market context at the time of writing major tokens are sliding into the news. As of May 22, 2026, Bitcoin is trading near $77,408, down 0.4% on the day and 3.7% on the week. Ethereum is at 2,198, down 0.2% on the day. And the Crypto Fear and Greed Index sits at 40 in neutral territory. XRP, which has historically traded at a heavy local premium on South Korean exchanges, is at 137, down 6.6% on the week. A tax abolition would not directly move price, but it would remove a structural overhang for Korean retail flows that has been priced in by some analysts since 2021. South Korean exchanges like Upbit and BitHum often see surges in spot volume when domestic policy turns friendlier, and a permanent tax-free regime would likely strengthen that pattern. Caveats on the news flow. The Watcher Guru post describes a policy consideration rather than a passed law. South Korea's tax code requires legislative action to remove a statute that is already on the books, even if it has not yet taken effect. Past delays have been authorized through the National Assembly's Tax Committee, and abolition would follow a similar process. Until a bill is filed and voted on, the 2027 implementation date remains the legal default. Traders should distinguish between political signaling and actual repeal. The same reporting cycle has surfaced multiple times since 2022, with each round of considering eventually producing a delay rather than full removal. The current signal is consistent with that pattern, though the political coalition pushing for outright abolition is reportedly broader this time.